Welcome to the GMS podcast, your weekly port of call for the latest on global ship recycling. I'm Henning.
And I'm Ingrid. Every week, we help you navigate market tides with insights from the world's largest buyer of ships and offshore assets for recycling, GMS.
If you're looking for full demo rankings, pricing intelligence, and regional port reports, the GMS Weekly has you covered. Subscribe at gmsinc.net or click the link in this episode's description.
Let's dive into the week. While the monsoon season rolls on, markets continue to wrestle with uncertainty. And surprise, from Red Sea security threats to rising U.S. inflation, the backdrop is anything but calm.
Absolutely. Global inflation ticked up again. U.S. CPI hit 2.7% in June, while the U.S. dollar strengthened against all major recycling currencies. Meanwhile, oil slipped slightly to 67.3 per barrel, and the Baltic Dry Index rose 1.1%, hitting its highest level since September 2024. That's added pressure on already scarce recycling tonnage.
But even with fundamentals flashing mixed signals, the volume story is starting to shift. A few large LNG units and dry bulk carriers finally made their way to the beaches, especially in Bangladesh and Pakistan. Still, the broader sentiment remains hesitant, with many cash buyers tabling sub-$400 offers.
Starting in Bangladesh, the tone is mixed. Chattogram welcomed nearly 66,000 LDT this week, including 2 sizable LNG carriers. But regulatory bottlenecks persist. Only 12 HKC yards are certified, and the rest are still scrambling for approval. Delays in issuing NOCs and opening LCs have become routine.
Local steel prices flatlined again at USD 552.58 per ton. That's troublesome, especially with mills importing cheaper steel around USD 330. The taka also weakened, ending the week at 121.63 against the dollar. Add in stalled elections and Trump's proposed 30% tariffs, and it's clear Bangladesh remains under pressure.
Over in India, the story is more stable, but not without setbacks. Aliaga took in over 42,000 LDT this week, mostly from higher value units, including non-ferrous rich LNGs. But the Indian rupee slipped back to 86.15, and steel plate prices dipped slightly to around USD 428.
Still, India's advantage is its infrastructure. With over 100 HKC certified yards, India remains the most reliable destination right now. Even though fundamentals are acting funny, Indian recyclers are staying active, and buyers seem willing to trade higher margins for safer deliveries.
Pakistan is shaping up, literally. Gadani recyclers are aggressively courting dry bulk units and topped regional pricing for the 4th straight week. Though the rupee dropped again, now at 284.73, and steel remains flat at USD 615 per ton, provisional DASR certifications are helping keep vessels moving.
That said, a new 15% withholding tax on services could complicate things. It's a bold move by the government, and industry voices are calling it economic sabotage. Whether Pakistan can keep its top spot will depend on how recyclers weather these new cost pressures.
And finally, Turkey. The Lira is in freefall, closing at 40.40 this week, and steel prices haven't recovered. No new vessels arrived at Aliaga, and with pricing corrections on the horizon, Turkish recyclers are taking a step back, even as some flirt with acting like local cash buyers.
So here's the breakdown. Pakistan leads in price, but faces risks. India holds steady as the safest bet. Bangladesh sees spotty volume, but continues to struggle. Turkey remains quiet and cautious.
That's it for this week's update. For more data, charts, and in-depth analysis, check out the full GMS Weekly, available via subscription or the GMS app.
Follow GMS on LinkedIn, X, Instagram, and Facebook to stay ahead of market moves.
Thanks for tuning in. We'll be back next week with more insights from across the beaches. Until then, stay sharp and stay safe.